Hey, Dmitry, thanks for taking out the time out of your day. I know you got a busy schedule, so thanks taking out some time and actually chatting with us a little bit. Before we jump into it, if you can you tell us a little bit about yourself and how you got into what you're currently doing, and also what your current role is on helping people, become a little bit more financially independent with buying properties and real estate within their, retirements.
Oh, sure, Peter. First of all, thanks for having me on your show. Excited to be here and share some wisdom and some of my experience, some knowledge. Hopefully your listeners will find it beneficial. Just a little bit about myself, as you and your listeners can hear from my accent. I'm not from here originally. I'm an immigrant. Moved in this country back in 1996 from Russia. I believe this is the best place on earth to live, and blessed to be here, frankly. And my background is in electromechanical engineering. That's what I went to school for back in Russia. Translated my degree here. Worked for a few years in the field. Actually got laid off and was introduced to real estate investing and financial services about at the same time. Worked in the financial services field and then transitioned full-time in real estate. Worked for a local real estate investment company here in Orange County in Southern California. And basically, because of my past experience and background, I was given the opportunity to start a department helping some of our clients with self-directed IRAs. Did that, and about a year later, transitioned on my own and started Sense Financial. And so essentially what we specialize in is helping our clients obtain checkbook control over their retirement accounts, their IRAs, 401ks, and so forth, and give them the opportunity to invest in alternative assets, such as real estate.
Yeah, that's awesome. So for people that aren't, and a great story, especially, immigration, immigrating here from Russia and being able to, live the American dream and build basically, a business after, you kind of got a little background to financial services, and now you're pushed into your own space, your own ability to, grow that company, which is awesome. And I've seen you a ton on Bigger Pockets, so I'm super excited to talk to you a little bit more today. So for the person, the listener that doesn't really know too much about, what their current retirement looks like, in the sense of maybe they have a 401k, but it's not a, self-directed IRA or a solo 401k. Can you kind of explain a little background between what are the top three products that you have that have really helped and outshined, other retirements for your clients?
Well, first let me explain what the self-directed means. And some people might think they have a self-directed IRA, but if you have an IRA or a 401k with conventional custodians, so like Fidelity or TD Ameritrade or Schwab or any other ones, any major banks, then essentially you have a custodian who holds your account, and they give you the investment choices. So they dictate what you can and cannot do. And that's certainly not a limitation that IRS places. Essentially, IRS rules say that you can use your IRA or 401k to invest in any kind of investment. But the problem is that if you are with the conventional custodian or institution, they're in business to make money, and they make money when you invest in their products. So that's why, as a custodian, they have the power to limit your investment choices. And again, it's typically limited to some stocks. I'm sorry, to some funds, typically that, again, they're mainly confined to the stock market. And so You might think that your retirement is diversified, but it's truly not, because you're just in one asset class. So a truly self-directed IRA is placed with a custodian that does not have those limitations. And you can essentially invest in alternative assets, not just some funds or certain stocks. You are free to go outside of the stock market and invest in things like real estate. You can actually own a rental property in your IRA. You can own a piece of a private company, a company that is not publicly traded on the stock exchange. You can invest in that. You can do that with the conventional retirement account. You can use your retirement account as a bank, essentially, and you can lend money to other people. That's my preferred way to invest my retirement funds, or one of the preferred ways. You can be the bank, and essentially you can lend money to other investors, to other people, and you can go on and on and on. Cryptocurrency been popular lately, and I have a client who actually started with about $100,000 in his Roth account a few years ago, and recently I spoke with him, and he has over $1 million in his investing in crypto. Yes, I personally think it's speculative. It's not really an investment by the definition. But the point is that if you're willing to speculate and things like that, you have the ability. And so for this guy, he has this almost $1 million in tax-free gains because it's inside of a Roth. So that's just to give you a flavor of what's possible.
Yeah, no, that's huge. I mean, Bitcoin, cryptocurrency, and all, that wrap into that are huge, are huge right now, because everybody's getting these massive increases in their investments. And granted, like you said, it's all speculation. There's not, some type of historical trend that we see outside of what we've seen since they started. We don't have 30, 40, 50 years of, being able to catch the trends, right? So for you, what's kind of the best, if I would, I'll put you in a scenario. So I'm a self-employed independent contractor, 1099, and I need an investment, and I'm not in a 401k right now or any type of investment through the employer. What would be kind of the best way that I should go to get a retirement account to invest in real estate?
Well, for somebody who's self-employed, and this is a great way, your question is a great way for me to transition or segue into a solo 401k, which is, you did mention that, but many people don't know what that is. So let me just explain your listeners what it is. Essentially, a solo 401k is a individual 401k designed for those people who are either self-employed or own a business without full-time employees. So if you're self-employed, kind of solo type of business owner, you might be a real estate agent. I have many clients who are in that position. Maybe you're just into, you may even have a full-time job, but you do some business on the side. For example, I have many of my clients who are flipping real estate. So they buy distressed properties, they fix them up over a period of a few months, and then they basically flip it, they resell it for significant gains. So that can be a side business, and you're in business for yourself. You're having employees that work for you. You may outsource all of the work. You don't have to do the labor yourself. So you have independent contractors who work for you, but essentially you're single owner business, and you're eligible for solo 401k. Some of the benefits that solo 401k has is that it also can be self-directed, just like an IRA. But the beauty, and that's where it actually surpasses an IRA, is that you don't need a custodian with Solo 401k. So it can be set up as a trust instead of with the third-party trust company. And you can be the trustee. Essentially, you kind of taking a role of a custodian, but you're not. You're a trustee, and as a trustee, you control your 401k trust. So trust is a separate entity. And as a trustee, again, you have the power to control it. So you can open a checking account at a bank of your choice or any other financial institution. And you can literally have a checkbook control over your 401k. And so that's one benefit. Now, to expand on that, that means that you eliminate all of the custodian and transaction and asset-based fees. Because if you have an IRA and you are with the custodian, which is required for every IRA, you pay annual fees, you pay transaction fees, you pay asset-based fees. So they do add up over time, and especially as your account grows and you make more investments, your fees grow. Well, with the Solo 401k, you eliminate all of that. So that's one of the benefits. The other one, again, if you're self-employed, if you're in business for yourself, that means that you actually have a much higher income potential. Because if you have a W-2 job, there is only so much you can earn. There is a limit. There is a limit what you can earn. But as a self-employed, you can be efficient at what you do, and you have much higher capacity to earn income. So with higher income comes obviously taxes, more taxes. So the more you make, the more taxes you pay. Well, Solo 401k is a great tax shelter because it allows you to shelter up to $58,000 of your income from taxes and into your 401k. Now, if you're a husband and wife team, like if you're together with your spouse in the business, or maybe you're mainly running it and your spouse just helping you, well, you have the potential of doubling those contribution limits. So take 58 times 2, you can shelter over $100,000 of your family income from taxes.
That's
huge. That can be huge. I mean, think about this. If you're sheltering over $100,000 of your income from taxes, so your taxable income all of a sudden drops by 100 grand. Well, that's gonna for sure drop you into a lower tax bracket. So you're gonna be paying significantly less at a lower rate. So the tax saving can be huge. So it is a great tax shelter. So just couple of main benefits that Solo 401k has.
Yeah, that I was always under the impression that it was only 58 or 53,000, not 58. So there's an extra 5 right there. So that's huge. And then, like you said, you can shelter all that money. You can put that, into play. And then you can also, if you have a spouse that's contributing, to the business somehow, some way, you can also obviously, shelter that $116,000, which is massive. So, and that's specifically for, someone that's working kind of independent contractor, working for yourself. What would you say if that person has, let's say 2 to 10 employees, and they wanted to do the same type of investing? Is there a different product that you would recommend or that they fit within the criteria outside of that Solo 401k?
Well, Solo 401k, unfortunately, will not work for somebody who owns a business with employees. They will not be eligible for Solo 401k. And by, the rules dictate that if you do have employees, eligible employees that work for you full-time or meeting certain threshold, then you must offer them retirement benefits as well. So that's why Solo cannot have the employees. Solo 401k cannot have the employees. Well, your option will be to do a checkbook IRA then. The end result will be similar. You can have a checkbook control over your IRA, but it is an IRA at the end of the day. It's not a 401k. Anybody can have an IRA. So you don't need to qualify for it. And it's a more complex structure. Takes longer to set up. There is a special purpose LLC that is involved. So it's more complex, more costly. But the end result will give you the same benefits or similar benefits, not all of the same benefits, similar benefits as far as the checkbook control and the ability to invest in alternative assets.
What's the difference between, and I'm just curious for myself, what's the difference between doing a SEP IRA versus a checkbook IRA?
Well, any IRA can be self-directed, and any IRA can be set up as a checkbook.
Okay.
So a traditional IRA can be set up as a checkbook. Roth IRA can be set up as a checkbook. And SEP IRA can potentially be set up as a checkbook as well.
Okay. All right. And what are the drawbacks? So let's say, I set up a solo 401k through you, and I buy 2 properties out of it. What are the drawbacks if I buy the properties, and are there some legalities that you would run into, or myself as an owner of those properties, if I did certain things while it's in that investment?
Well, what you do need to understand, well, first of all, it's not you who own the property.
Yeah.
So if you buy a property in your 401k, then you're not the owner. 401k owns the properties. 401k is on the title. You as the trustee control it. Same thing with an IRA. You don't own it. IRA owns the property. But back to your example, if you buy a rental in your 401k, you and your immediate family members are considered disqualified persons to your 401k. So disqualified persons is essentially yourself, the account owner, spouse of the owner, linear descendants and ascendants, and spouses of linear descendants. So basically, think of it a vertical line. IRS rules dictate that disqualified person may not receive any benefits from any investment that a plan owns, and disqualified person may not provide any services to the plan. So let me give you a couple examples.
Yeah, that'd be great.
I was talking to someone just yesterday, who actually was considering buying like a vacation rental in a 401k, and wanted to actually use that vacation rental themselves. And I said, no, you cannot do that. Absolutely not, because you are a disqualified person. This is for the benefits of your 401k, not for your personal benefits. So you cannot even stay a single night in that property, you or any of your family members, regardless whether you pay a market rent to your 401k or not. You will be in violation. You'd be violating the rule, disqualifying the plan. So you cannot receive any benefits. And also, you cannot provide any services to the plan. And the services, if you're a handyman, for example, if you buy a property in your 401k, you cannot perform any work on the property yourself. So you control it as a trustee. You can pay the bills, but you cannot do the work yourself. So if the property needs new painting, you have to hire somebody to do the work. If the property needs yard to be taken care of, you cannot go and do the yard work yourself. You have to hire somebody. Now you have the freedom to decide who's going to do the work, and you have the flexibility and control to pay for that work. So you can write the check and pay for the work, but you cannot do it yourself. So it's very important to understand that there are limitations, and there are certain things that you cannot do. You got to stay within the rules. It's very important to understand the rules. Also, let me expand on this a little bit more. And this actually comes up once in a while. I speak with someone who has certain expectations, or maybe certain plans to do certain things. Like in the example yesterday, this guy, he actually was thinking of buying a property and using it himself. That could be an example. Or maybe it's, like I said, once in a while I talk to somebody who is in a flipping business, and they flip properties, and they wanted to basically do some of the flipping in the 401k.
I was just going to ask that.
Shelter the income.
Yeah.
And they wanted to do the work themselves. And I explained, no, you cannot do that. And then, the response can be, well, that's not what I expected. Then this is not for me. And so they kind of get cold feet and kind of disappointed with my answer. And my response to them is this. It's self-directed IRA or a 401k can be a very powerful vehicle. Like an example I gave you earlier, one of my clients investing $100,000 and then just a few years growing it to $1 million, tax-free. I mean, this is extremely powerful. So, so my recommendation is, rather than getting disappointed that the rules are not what you expect them to be, because listen, honestly, there are rules for everything, right? If you if you have a car and you want to drive from point A to point B, you must obey traffic rules, right? If you're driving your car off of your driveway, you must stay on the right side of the road. When you approach stop sign, you must stop. If there is a red light, you must stop on red light. So you have to understand and embrace the rules, because if you don't, you might say, well, I'm approaching a red light and there is no one around, no one is looking, I may as well go. Well, if you do, you have a risk of killing somebody or getting killed yourself. So you don't want to do that. You want to obey the rules. Same thing with the retirement accounts. There are certain rules. Rather than seeing that as limitation, you want to embrace those rules, follow the rules, and the end result can surpass your expectations.
Yeah, it's kind of like you look at it as, if it was that seamless and you could do everything, work on the property yourself, do all these certain things, and there was no rules behind it, then wouldn't everybody be doing it? Wouldn't everybody, Solo 401k would be a household name, amongst every single person, because they can throw any money they want in there, buy their own primary, buy their own, real estate investments, and keep it all in that Solo and 401k and never pay any taxes. And then, so there are rules, you got to abide by them, and you got to make sure that you're within those parameters, because if you're not, then ultimately you can, have some issues that you're going to have down the line. So, that's key information, so I'm glad that you brought that up, especially, not working on your own properties and those other things. So if I was going to go flip a property, so let's say I want to flip a couple properties and I put them in there, am I able to do that if I'm using different contractors, and everything else, if I'm able to do that as a business and inside of Solo 401k?
Well, that's a good question. And let me just explain that retirement accounts, they are basically designed to invest passively. Okay, so now question about flipping a property in the 401k. Well, you could potentially flip a property in the 401k, but like I explained, you're prohibited from doing any work yourself. Now, you could hire contractors and you can basically control the contractors and oversee that, but you cannot do the work yourself. But there is also another issue that you need to be aware of, because flipping typically consider it an active business, especially if you're not just talking about a single property, but if you're talking about one property after another. So if there is multiple properties and you repeat the process, then that becomes a business. And if there is a income from a business activity inside of a tax exempt entity, like whether it's a retirement account or whether it's some nonprofit down the street, like a church or some other nonprofit that is out there. So if a nonprofit let's say, use example of a church, right? Church is a nonprofit, so donations that they receive is not taxable. But if church decides to start flipping properties, well, I guess, should the church be exempt from the taxes on gains from the flips? No, because that's not nature of their business. The nature of their business is, different. And the donations will not be taxed, but if they have a profit from the business, that will be taxed. And that's called unrelated business income. Because that income is not related to the nature of that nonprofit or nature of that tax exempt entity. So flipping will fall into that category. So if there is a income from the flipping business, then UBIT would apply, and UBIT stands for unrelated business income tax. And you have to look at the overall situation. So it's if you just happen to flip one property, especially if your intention was to hold on to it, you wanted to hold that property as a rental, and you rehab that, but then you got an offer and you couldn't refuse that. Well, if it's a kind of isolated incident, you probably be fine. But if you're doing this on a regular basis, and if you're flipping 10 properties a year in your 401k, that's definitely looks like a business, and you will be taxed as a business.
Yeah, I kind of figured that. I didn't know that specific answer. So that's good to hear. And so are these, when you get to 59.5, can you start taking that money out once you hit that threshold, just like any other retirement account?
Exactly. The rules are the same. So self-directed IRA or self-directed solo 401k, they are retirement plans. And essentially the rules are the same, as far as the contribution rules or distribution rules, tax rules are the same. So if it's a Roth, you can pull out qualified distributions tax-free after you reach retirement age. For Roth, it will be 59.5, and you have to have the account for at least 5 years. For a pre-tax accounts like a traditional IRA or pre-tax 401k, when you take a distribution, that becomes a taxable event. So you do pay ordinary income tax on a distribution, but only on the amount of the distribution. The rest of the account continues to grow tax deferred. But essentially tax rules, distribution, contribution rules are the same as any other retirement accounts. Okay.
All right. And if I was leaving an employer, so let's say tomorrow I left an employer and I had a 401k there with $200,000 in it, can I move it over without any type of payment of taxes or anything like that into a solo 401k?
If you're eligible for solo 401k, you can set one up and move the previous employer 401k. If you're not eligible for solo 401k, you can set up a checkbook IRA and move that. Speaking of so IRA can be moved. If you have an IRA, there is nothing holds you back. If you have an employer-sponsored plan, like in your example of 401k, if you're still working for the employer, the chances are you will not be able to touch those funds. You cannot move them elsewhere because typically you have to wait until you reach retirement age or you're no longer employed there. So in your example, if you're leaving the employer and you have or you left the employer and you still have a 401k left there, then you can move that. So you can freely move that. But with the current employer 401k, most likely you won't be able to move it. Sometimes you can move portion depending on how long you've been there. There might be vested amounts that you'll be eligible to move.
Okay. Let's talk about, as an advisory role with you and talking to your clients, is there a specific threshold that you give your clients, hey, you should be saving 10% of your money each month into one of these investments? Doesn't matter if it's solo 401k or a checkbook IRA. Is there kind of a guideline? And if so, what is that guideline that you base it off?
Well, I'm not really an advisor. currently I don't have that role. I'm advising on self-directed retirement accounts, not just I don't offer a financial advice, but you should definitely be saving. I can just talk in general terms. Save as much as you can, especially in the beginning of your in the younger years, right? You want to save as much as you can, because we live in the society that is a spending society, and people grow up and basically conditioned to spend, and they've got nothing to show for it. So you want to be kind of go counterculture, and you want to save, if you can, 10%. If you can save 50%, do it. Learn the concept of the deferred gratification. If you're able to save 50%, I been part of the Dave Ramsey's program. I don't know if you've heard about him, but actually taught it for a period of time. And
did you?
He's teaching a concept of this. If you do what, trying to remember how it sounds. If you live like no one else, later you will live like no one else. So if most people don't save 50%, but if you do save 50%, you'll be exception. But guess what? Pretty soon, if you invest that wisely, pretty soon you're gonna live like no one else. You can reach financial independence in your 40s, like I did, and you can have the freedom. You don't have to go and work for someone for until you're 65 or 70, like most people have to do it. You'll have choices. You'll have the freedom in your life. So, generally, you want to save as much as you can, and you want to invest that. Not just save. You want to invest your savings wisely.
Yeah, I agree 100%. I follow Dave Ramsey, and I still practice a lot of his principles that he's instilled in a lot of people. And I used to listen to him a long time ago every single day when I drove driving back and forth to work. So for you, and speaking about financial freedom, especially at a younger age and stuff like that, how did you put those principles into play? Not Dave Ramsey's, just your own, and maybe some of his, but how did you kind of build that up into your family's goals so you could be financially free, at a certain age? How were you able to do that?
Well, it kind of goes along the lines what I mentioned, but you wanna learn below your means, and again, unfortunately, that's not the norm. Of the society that we live in. Most people live beyond their means. So you want to live below your means. You want to, and the problem is, because I did mention, prior to this, I was in financial services, just helping folks with just traditional IRAs and 401ks, mutual funds investing and things like that. And I've seen people that as their income increases, so does their lifestyle. And that's the problem. Then you can't ever get ahead if you keep increasing your expenses, or your living, just standard of living follows your increases in income. Then you're going to be in that rat race, so to speak, for the rest of your life. So I learned that early on. So I always and still continue to live below my means. So that's one thing you want to do. You want to make sure that you're not spending everything. We can go on and on and on. There's many things to discuss here, but just generally speaking, start there.
Yeah, I agree. So what are some things that I didn't ask you about solo 401k, checkbook IRA that we didn't cover that are good for, that foundational knowledge for people that are listening and potentially wanting to get into it or contact you or, get into a checkbook IRA or solo 401k? Is there a couple of things that I missed that are basic that you can provide to them?
Well, just maybe expand on some of the benefits of the solo 401k. I kind of started covering some of them, but not all. So as I mentioned, it does not require a custodian, so you can be in control of your funds and have a checkbook control. Another benefit that comes out of this, that means that you're saving on the maintenance. There is no transaction fees that you're paying to the third party, so it's very cost effective. We talked about the ability to make high contributions, which means it's a great tax shelter. Well, a solo 401k plan also comes with the ability to make Roth contributions. So you can get a tax deduction now, or you can actually contribute a portion of your income post-tax. So you pay the taxes now, and then you contribute post-tax into a Roth. Or you can actually take existing pre-tax money and convert them to Roth and then invest. So think about this. Would you rather pay taxes on the seed that you're planting, small seed, or a harvest? If you have a huge tree that grow out of that little seed. So yeah, it does make sense to pay the tax on the seed rather than on the harvest. And that's what the Roth allows you to do so. And there is no simple solution that will fit everyone.
Yeah.
Everyone's situation is different. And, in the younger years, if you're younger and if you're in a smaller tax bracket, maximize Roth contributions. So you can grow this tax-free because you have more time. Number one, you'll have more time to grow. And if you're in a lower tax bracket, it's not going to cost you as much. But and I personally kind of done both. I like to do both. I don't like to have all of my income tax-free eventually, because I do invest in real estate and I realize the tremendous tax benefits that real estate offers. So I don't mind having some income because I can offset that income with phantom losses from my real estate investments. But it's definitely nice to have some tax-free income. So I think doing a combination is great. So, and solo 401k allows you to do that. Your spouse can participate. Another benefit is that, I normally don't like to, over promote that, and that's not what I'm doing, but just to mention it, is that with the solo 401k, there is a built-in participant loan feature, which allows you to actually take a loan from your 401k. So you can borrow from your 401k up to 50 grand for whatever the need is. So it's like, think of it, your own private bank that will never tune you down. So you have the ability to do so. You don't want to abuse this feature because essentially you're pulling out your own retirement money, which could be invested in a tax-deferred or a tax-free environment. But it's a nice feature to have should you need some funds, because otherwise, if you have an IRA and you need funds, the only way to access those funds is to take a distribution. Well, early distribution will be subject to taxes and penalties. Here is a good example. This lady has been a client for a number of years, probably over 5 years, maybe more. Okay. Initially, she came to me and she had some high interest medical debt. I think not a whole lot, maybe for her it was, but I think $10,000 or something along those lines.
Okay.
And she was actually considering pulling out money from retirement because she was just paying the interest. She, for years, she didn't see a balance going down, and she was just covering the interest payments. And so she was considering actually taking or cashing her retirement account. And after she met with her CPA, she's been told that she needs to pull out about $20,000 so that after paying taxes and penalties, she will have $10,000 left to pay off that medical debt that she had. So nearly 50% would have been lost. Well, after we met, and talk and kind of looked at her situation and what the strategies were, kind of, try to strategize. She had a side business. She did qualify for a solo 401k. So she was able to set up a solo 401k, move her retirement account without any tax consequences. It was a direct rollover, so zero tax consequences. She pulled out a loan for 10 grand, paid off that medical debt, and now she's paying back to her own retirement account. So her retirement account is actually growing, and the balance of the money that she otherwise would have paid to Uncle Sam, she's investing. So again, it can be a useful feature, not for everyone, but it is there.
Yeah, I think those loans are huge. Kind of that brings up a great point, because I know that a lot of people came, and they granted that CARES Act where you can pull money out, in an emergency. But those funds were taxable, correct?
Well, yeah, there were a couple of things. You could take a distribution, and the taxes were spread over 3 years.
Okay.
But if you actually paid it back within 3 years, you had the ability to basically pay the distribution back. And if you did, then it will not be taxable event.
Got it.
Or you could take a loan from your 401k, and the loan limit was doubled, so it was up to $100,000.
Yeah.
If you had the need, you could do that, and again, loan is not taxable as long as you pay it back.
Yeah, that was huge. I figured you would know the details on that. So, kind of going forward with, this topic, and, every year it seems like the government will loosen up a little bit of the money, and you can, ultimately put more money into a retirement account. Has that changed from the 50, recently, or in the last couple of years? Because I know the 401k and the 457 have gone up, monetarily every year. Has that happened with the checkbook or the solo 401k?
The rules are the same. So yeah,
okay.
the limits were raised recently, and typically IRS does raise a limit every 2 to 3 years on the 401k. So you'll see like $1,000 increase.
Yeah.
It used to be, you did mention, I think, $53,000. Well, that was a limit a few years ago.
Okay.
Now it's $58,000. So it's been going up every few years by $1,000 or so. As far as the limit on IRA, currently it's $6,500. It used to be $5,000 a few years ago, but it's gone to $5,500, then $6,000, now $6,500. So yeah, they do go up slightly with inflation. But again, comparing IRA to 401k, 401k offers you ability to contribute nearly 10 times more.
Yeah.
So that's huge.
Yeah. That's massive. Well, before we get out of here, I know you have, a ton of knowledge on a bunch of the topics. Do you have any examples of, maybe some recent people that have gotten into it maybe later in the years? So let's say if we're talking to someone that's, you have a client that came to you in their early to mid 50s and they're trying to catch up. Have you seen some wins on that front, where someone came to you and they were a little bit older and they were able to invest and capitalize on that, higher contribution, and then on top of that, buying some rental properties or some properties within that solo 401k or checkbook IRA, and growing that significantly?
Well, you certainly can do that. With an IRA, there is a $1,000 catch up.
Mm-hmm.
So if you're over 50, you can put additional $1,000, which is honestly, that's not making any huge difference there. But with the solo 401k, the limit, just a normal limit, is $58,000, so nearly 10 times higher. And if you are over 50, then you've got $6,500 catch up. So that essentially makes the limit of $53,500. initially when I started Sense Financial, we used to just do IRAs. We worked with IRA clients only, and every single client we had, they would start with a rollover, because to do a self-directed IRA and invest in alternative assets, most of my clients at the time were real estate investors. So you need a lot more than just $6,000 to invest in real estate, right?
Yeah.
You don't do a 1-year contribution and then start real estate investing with that. That's just not enough funds. So I will have people who had other IRAs or 401ks from the former employers, and they will bring, $60, $100, $200, $300,000, and then they start they buy properties with that. Well, when we rolled out a solo 401k, we actually have probably, I don't know the exact numbers, but probably close to half of our clients, they start from scratch. They don't have any retirement accounts to roll over, but because of the high contribution limit, again, if you're single, almost 60 grand. If you're together with your spouse, you can put in well over $100,000 in a single year. So just a 1-year contribution is enough to get going and do something serious with your money.
Yeah.
So certainly, even if you're listening and you might be in your later years, it's better to do something later than never.
Yeah, 100%. I agree with that. You always need to invest. Doesn't matter if later, early, whatever it is, just continue to invest, because, obviously later in life you need it, but it shouldn't stop you if you're a little bit older. So that's gold, especially when you're talking to other people that, like you just said, there's a significant amount of people that come to you and have conversations where they haven't invested for, the vast majority of their life. And they're coming to you with, zero on their account, trying to grow it as quickly as possible because they know retirement is, imminent. So, Dmitry, we'll transition a little bit, and there's a couple extra questions here for you. Is there a book that you could recommend all the listeners that has helped you kind of along the way of your journey in real estate, and then also just investing in general?
Sure. You probably know it, and probably most of your listeners know it, but it's kind of a classic, and it has been really influential for me. And that's Rich Dad Poor Dad by Robert Kiyosaki and a Cash Flow Quadrant. Those two books, I would, I have my daughter read them. I just recently was visiting my brother and bought both of these books for my nephews to read. And it's really great concept to understand early on. So I will say both of these books were, helpful in having the right mindset for me.
Yeah, for sure. I agree 100%. Rich Dad Poor Dad is obviously, a staple in the vast majority of people's households, especially the ones I talk to on this podcast. Okay. And is there a tool or resource that you use on a daily or weekly basis that really helps you be proficient in your business?
Sure. Well, I use Evernote.
Okay.
Evernote is basically it's a note app. You can there is a web version. You can use it online in the browser if you're on your computer, but you can also use it you can download the app on your phone, and it's very helpful. There are different categories and tags, and I pretty much use it for everything. And actually transitioning more and more of my data and actually for work as well. I use it both personally and professionally. So it's a great tool because it helps me stay organized and find things quickly when needed.
Yeah. I've, I used to use that. and I don't anymore, and I should probably get back to it. So it's super helpful, and it's got a ton of different features, like you said, that really helps you outline, what you're looking for, and your notes that you're jotting down. Okay, perfect. And Dmitry, where can people find out more about you and your business and your services and everything else?
Our website probably be the first step, sensefinancial.com, and sense is like a common sense, SENSE, sensefinancial.com, and the story behind this, because what we talk about is those concepts, they do make sense.
Yeah.
You can also find me on Facebook, on LinkedIn, and on Bigger Pockets.
Yeah. I see you on there a lot. Okay, perfect. Well, this has been awesome. This has been, super enlightening, especially, for those people that don't really, know too much about solo 401ks and also, checkbook IRAs. It's very beneficial. I know a lot of people that, get into it and they're very successful with them because they've, built up their wealth buying properties in those types of products. So I appreciate your time, and I appreciate, your knowledge, you being able to give us today.
Thanks, Pierre. It was great.
Yeah, of course. Thanks, Dmitry. Have a great day.
Mm-hmm.